Hello, everyone. Mike Fleming here. And Ellie will not be joining us today. She just lost power. Big snowstorm out in Colorado, and here up in East Texas, we're starting to get some, far northeast Texas, we're starting to get some bad weather. So I'm going to turn my camera off. We're losing bandwidth. Um, and we'll try to get through today's presentation. As everyone's joining, I'm just going to do some housekeeping. If you're here for CPE credit, you're going to have to answer all of the poll questions. And at the end, once you sign off, you'll get a survey. You'll need to fill out the survey at the end of the webinar. If for some reason you don't get the survey or can't see the poll questions, please let me know. Few more things. If you have questions, please ask them. We'll either answer the questions at the end of this webinar or email you after the fact. There is a questions button that you can use. We'll also be sending out the slides. You actually should have gotten the slides. Ellie texted me and let me know that she has emailed everyone who's attending the slides right now. So you should have those in your email. We have also a series of pre-recorded webinars. They're in our paid portion of our website called the Salt Vault. They also can be purchased independently, but the Salt Vault, pretty good resource here. Lots of things included in that, lots and lots of charts. So if you have an interest in that, please reach out to us and we will get you some more information on it. A couple quick introduction. Who is Sales Tax and More? We're state and local tax specialists. We concentrate in the U.S. Hold on 1 second, I'm sorry. Okay, that was Ellie trying to get a hold of me. We practice in the U.S., Canada, and Puerto Rico. Our clients come from across the globe for help with the United States, Canada, and Puerto Rico. We've got a very comprehensive list of services. We do a lot of sales tax returns. We do a lot of exemption certificate management, a lot of research, a lot of registrations. Not only sales tax registrations, but Secretary of State registrations, payroll registrations. I mean, like our name says, a whole lot more. A little bit about me. I am originally from New York City. This will be my 35th year here in Texas. I have founded Sales Tax and More, and I'm a registered CMI through the Institute for Professionals in Taxation. Today, we're going to cover the state tax rates, which states' rates we should use. We're going to talk about local rates. We're going to talk about sourcing rules. That plays a big part in which state's rate we should use. We're going to go over it for tangible personal property, for services, for digital products. We're going to talk about some sourcing examples and then options for getting rates. So here is the beginning of the presentation here. We're going to start talking about this. The biggest question I get when it comes to rates is, what rate should I use? And it's not always an easy answer. You know, I've never counted these dots myself. Someone's told me there's 13,000 different colors and jurisdictions on there. I've heard numbers anywhere between 7,500 and 15,000, but each color represents a different taxing jurisdiction. So it's not as easy as it sounds sometimes. So we are going to talk about some ways to make this a little bit simpler as we go through today's presentation. Now, in order to answer the question of which rate to use, the first thing we need to do is to figure out where the sale is sourced. In other words, which jurisdiction has the right to tax the sale. And as I mentioned earlier, we're going to address the sourcing of TPP services in digital property. We're going to look at the state levels first, and then we're going to go into the local jurisdictions. And before we go any further, why don't we do that first poll question? See if I can get this launched. Okay, so the first poll question is, have you attended previous webinars? Those answers are coming in pretty quickly. I'm going to give everybody a couple more seconds here and then end this poll. If you did not get a chance to answer, just shoot me uh, uh, instant message and we'll mark that as you having answered the question. All right, so when we're talking about sourcing, this is something that comes up quite a lot. And this is origin versus destination sourcing. And origin uses the address of the seller's business. Okay, that's the in general answer there. But this is for interstate sales only, a sale that never leaves the state's border, and it only impacts the local taxes. The software companies out there, one in particular, TaxStar, was making such a big deal about this origin versus destination sourcing that people were actually telling me, well, Mike, I don't need to worry about collecting tax in other states because I'm in an origin-based state. So I only have to worry about the taxes in my own state. And no, it doesn't work that way. This only impacts local taxes. It only impacts when a sale never leaves the state. On interstate sales, sales that cross a state border, in general, the destination is what we're going to be using, and that uses the address of the customer. So origin is only to figure out which local rate to charge on an intra-state sale, a sale that never crosses a state boundary. So, origin is important to know, but not to the point that some of these software companies are making an issue of this out there. So, yes, you still have to collect tax in other states if you have nexus, if you're in an origin state. All right, so let's start by the sourcing of tangible personal property. And states generally base their sourcing rules for TPP, which is short for tangible personal property, on where the purchaser or their representative take possession. So common carriers are not considered representatives, they're not considered agents. So in most instances, the ship to or delivery address is where TPP should be sourced. Now, Incoterms are generally ignored in the United States when it comes to shipping, and it doesn't matter who pays for the shipping or who orders the shipping. If a common carrier is being used, then generally you're going to use the destination state. So that's where the customer is or the purchaser is taking possession. Now, if the purchaser sends their own trucks or sends an agent to come and pick it up at your location, um, uh, who could be an agent? Well, maybe they have a captive trucking company or someone who doesn't hold themselves out to the general public. That's what a common carrier is. Someone who holds themselves out to the general public to be in the business of the logistics business or trucking business or something along those lines. So if someone's not doing that, if you could not go out and hire them on your own, they only work with limited contracts, then that could be an agent. So if an agent is coming to pick up at your location, then that's where they're taking possession. So where the purchaser or the representative is taking possession. All right, so exceptions to the ship to address. We just talked about the purchaser or their agent picking up in their own trucks or using a private carrier. Sale is generally sourced to the pickup location. Common carriers are generally not considered representatives. We mentioned that. So the ship to address is still used, no matter who orders it or pays for it. And common carrier, the U.S. Postal Service would also be lumped in with the common carrier. Some examples of common carriers are FedEx, UPS, any of the big logistics or trucking companies out there. These would all be considered common carriers. Now, here's a distinction between a common carrier versus a private carrier. This is courtesy of the Legal Information Institute. A common carrier is a person or commercial enterprise that transports passengers or goods for a fee and establishes that their service is open to the general public. Typical examples include ship owners, railroads, airlines, taxi services. A private carrier, on the other hand, is a person or commercial enterprise that only agrees in particular circumstances to transport passengers or goods. Private carriers differ from the common carriers because they don't establish that their service is open to the general public. In other words, private carriers enter into a contract with each customer without assumption that a similar contract will be available to the next customer. Okay, so let's go on to the second poll question here. All right, true or false? The sourcing of services can be specific to a service. Sometimes a state can have different rules for different services within the state. Answers are coming in quick. All right, most of you are saying that this is true. We have a couple saying it's false. The answer to this is true, and we will cover this as we go forward. All right, I'm ending this poll. All right, so let's look at some examples of tangible personal property. All right, so in example one, let's say that the customer in state A places an order with the seller in state B. The seller has a common carrier deliver the tangible personal property to the customer in state A. All right, so remember the rule is where the purchaser, that would be your customer, where they're taking possession. So if we're shipping it to state A, we're using a common carrier, this sale is going to be sourced to state A. Example number two, customer in state A places an order with the seller in state B, same fact so far, but the customer arranges and pays for a common carrier to pick up from the seller in state B and deliver to a different location in state C. In this instance, because it's a common carrier, even though the purchaser paid for it, the sale is going to be sourced to state C. That's where it's being shipped. That's the delivery address. All right, so let's look at a couple more examples. Example three, the customer's in state B, the seller's in state B. The customer sends their own trucks to pick up from the seller in state B and deliver to a different location in state C. All right, so remember, where does the purchaser take possession? Well, if they're sending their own trucks and they're picking up in state B, that is where the sale is sourced. As a seller, we don't care what the purchaser does with that product. after he picks up from us. So in general, that sale is going to be sourced to state B. And there's exceptions to every rule out there, but that is going to be the general rule. So example 4, the customer in state A places an order with the seller in state B, and the customer's representative in state D sends a contract carrier to pick up from the seller in state B and deliver to a different location in state C. So the contract carrier, not a common carrier. So the representative sent it to state B. That's where the possession is taking place. So again, the sale is going to be sourced to state B. All right, so what about services? And when we're talking about sales and use tax purposes, they're sourced differently for income tax purposes sometimes. Services are generally sourced to one of the following: where the service is actually performed, where the benefit is received, or the customer's principal place of business. So these are the three main ways that it happens. And as the last poll question mentioned, the sourcing of services can be specific to a service. Sometimes a state can have different rules for different services within the state. Sometimes it's fairly easy to figure out, sometimes not so much. So let's look at this one. This is Connecticut service sourcing. As we said, with some, it's easy to tell where the service is performed and where the benefit is received. It's often the same place. For example, landscaping. Benefits received where the landscaping is getting done, and that coincides with where the service is being performed. Pool cleaning, pet grooming, health and athletic club services, janitorial services, babysitting, hair weaving. These all follow the same sorts of rules. Now, let's look at one that's a little bit different. And this was an employment service. And the hiring company is outside of Connecticut. Let's say they're in state A. The employment agency is outside of Connecticut. They're in state B. The candidates are outside of Connecticut in states A, B, C, and D. The jobs that are going to be filled are all in Connecticut. And Connecticut takes the position that this service is sourced to Connecticut because the benefit is received in Connecticut. So it's not always clear there. You could try to say, well, the company that is hiring people is located in state A. They're the ones who receive the benefit of this. But it's the actual office in Connecticut that is receiving the actual benefits. So these jobs would be sourced to Connecticut. These services would be sourced to Connecticut because that's where the jobs are being filled. So like we said, it's not always very straightforward. Texas services sourcing. Information services and credit processing services. If the work is performed in Texas and the customer is in Texas, then the sale is sourced to Texas. If the service is used to support a separate and identifiable segment of the business, that is where the sale is sourced. If this service cannot be assigned to an independent segment, then the service is presumed to be used to support the general administration at the customer's principal place of business. So this is that third method that we talked about, the customer's principal place of business. So here's a case study about services. This is one I was actually involved with a couple of years back. Company in New York hired a detective agency in New Jersey. The detective agency had an employee in Texas who did all of the work. Now, most of the work was done in Minnesota, where the subject lives. And this was, they were an insurance company who was trying to figure out if someone was actually disabled and wasn't able to work, and they were following up on him. They wanted to make sure that he wasn't out there doing other things. So this subject lived in Minnesota, and that's where most of the work was done. Most of uh, the detective work was done, where they, monitored the subject, where they talked to people about the subject. But the report was created in Texas. So could you say was the work done in Texas? Now, the report was delivered to the New York company, and that's where the benefit was received. So this ended up being a taxable service in New York because the benefit was received in New York, even though a lot of the work was done in Minnesota, a lot of the work was done in Texas. The people that the New York company hired were located in New Jersey. So lots of different states involved here, but where was the benefit received? And this is a big one when we're sourcing services. So the benefit was received in New York, where the company that would have to make the payouts was located. All right, so sourcing of digital property. Digital property is generally sourced using a hierarchy of knowledge that was known at the time of sale. Not all states use the same exact hierarchy, but they all are fairly similar. So we're going to look at a sample North Carolina on the next slide. And it's important to note that when you're using a hierarchy, you cannot manipulate it to provide a result that you want. That constitutes bad faith, and you can get yourself in trouble. All right, so here's North Carolina. This is an example of their hierarchy of knowledge. When a purchaser receives digital property at a business location of the seller, the sale is sourced to that business location. When a purchaser or purchases Donnie receives digital property at a location specified by the purchaser, and the location is not a business location of the seller, the sale is sourced to the location where the purchaser receives the product. When one or two are inapplicable, the sale of digital property is sourced to the location indicated by an address for the purchaser that is available from the business records of the seller and that are maintained in the ordinary course of the seller's business. When use of this address does not constitute bad faith. When one, two, or three are not applicable or are inapplicable, the sale of digital property is sourced to the location indicated by an address or purchaser obtained during the consummation of the sale, including the address of a purchaser's payment instrument. In other words, if you're using a credit card, the billing address of the credit card is often going to be the state that does this. And when 1, 2, 3, and 4 are inapplicable, including the circumstances in which the seller is without sufficient information to apply the rules, the location will be determined based on the address from which the digital good was first available for transmission by the seller. Now, some people say, "Oh, I don't have any of that other information, so I'm just going to go from number 5. I'm registered in this state, and I'm going to be transmitting from here, so this is what I'm going to go." Doesn't work that way. You have to go through this hierarchy, and generally, at the very least, you're going to get some credit card information at number 4. So that would be based on the bill to address. Where tangible personal property is generally going to be the ship to address, digital property often defaults to the bill to address, or the address on number 3 that you have in your books and records. I mean, if you're selling to a business and you have the location of that business in your books and records, that's what you would use. So it's a hierarchy of knowledge. You start at number 1, and if you can't meet that, you go to number 2, number 3, number 4, and finally number 5. Okay, so most common results. Number two, if the seller tells you where it will be downloaded, or if your technology can determine where it's downloaded, that is where it should be sourced. An address located in your books and records for the purchaser, repeat customers would be a good example. Or an address obtained during the sales transaction, like a billing address for a credit card. All right, so we're going to go to our next poll question here. This is poll question number 3. Why is the average local rate about 1.5% misleading? And this is going to be answered in the coming information. And your choices are, in some states, local rates may be as high as 9.75. The rate is a high representation of the average, or most states have local rates of 0%. I'll give you a hint. Number 3 is not correct. All right, looks like most people have answered here. If you haven't had a chance to answer, shoot me an IM. And the it's a little bit confusing here, but the correct answer, as I'm reading it here, is in some states, local rates may be as high as 9.75. So although the average local rate is about 1.5%, that can be very misleading because some states have a wide range from the low to the high. All right, so we're going to start talking about local rates right now. Historically speaking, there are a couple of factors that could influence whether a local rate was charged. And some of these factors were, was this an interstate sale or an intrastate sale? What type of registration was required? Was this a sales tax or a seller's use tax? The state had a big impact on this. Some states don't have local rates. And some states have different rules for whether you register for a sales tax or a seller's use tax. And the time period, we have before 1977, before 2018, or after 2018, and this can all change. So excuse me, prior to 1977, losing my voice here, intrastate sales were generally considered a sales tax, and interstate sales a use tax. And that was because when we had the first modern sales taxes come out in the 1930s, even states didn't think that you could tax interstate commerce directly. So a sales tax was only for intrastate sales, sales that never crossed a border. We had the compensating use tax, which was for the storage, use, or consumption of a product inside a state. And, sellers may have to collect that if they did have nexus. So all interstate sales were considered technically to be a use tax back then. So nowadays, when we think of use tax, we think of the consumer use tax, but there are still a number of states out there that make a distinction between a seller's use tax, a vendor's use tax, a retailer's use tax, and a sales tax. Now, 1977 is a pivotal year because in 1977, we had complete auto transit, and this was a U.S. Supreme Court case. And, the U.S. Supreme Court said that, yes, states can tax interstate commerce directly so long as it meets a 4-pronged test. So we began to see the blurring of the lines. And some states did away with the distinction altogether. And when you registered, you would register for the sales use, or like in Pennsylvania, the hotel occupancy. It's one registration. Other states still made a distinction. And in 2018, which is the next pivotal year, we had Wayfair. And after Wayfair, a lot of states took the position, okay, well, if you have a substantial nexus due to an economic nexus, we're going to treat that the same as this being an in-state sale. So if you haven't, like Colorado, if you had an economic nexus in Colorado, um, all of a sudden, instead of collecting the seller's use tax, you would be collecting the sales tax. And the reason why that's important, a lot of times, if you were collecting the use tax, it was only the state rate. You didn't have to worry about collecting the local rates. So big changes in 1977 and then in 2018, and states are continuing to change this. Um, as a result of Wayfair, many states made remote sellers convert to a sales tax. You've got other states like Illinois, they get really confusing, and I think they're going to have a constitutional issue here. They say that if you have a location that where you ship from inside of Illinois, then you're going to use the retailer's occupation tax, which is their sales tax, and it's origin based. If you have just an economic nexus, if you have no physical nexus whatsoever, then you're going to use the retailer's occupation tax destination based. And there's about 4,000 different jurisdictions you have to worry about in Illinois then. And if you have a physical nexus in Illinois, like say you have a traveling salesperson, but you're not shipping, you have no inventory located in Illinois, then you can set up for the retailer's use tax, which doesn't require any local tax collection. So this can get fairly complicated. And I see a lot of problems with this when people are working with software companies, because the software companies generally don't tell you which of these ways you should be collecting the tax, and they're just going to remit the tax as you're collecting it. So a lot of the companies didn't tell people to switch over in 2021 when Illinois made this change from they added the destination based for these if you're a true economic nexus seller. There's currently a lawsuit out there about that. I think it will go to the Supreme Court, and I think that it'll get overturned. Whenever I say that, people say, well, I'll just stop collecting tax in Illinois. It's an easy fix, and states can sometimes go back and do things retroactively. I would still collect. Yes, it's a pain in the neck. We've had to hire an extra 3 or 4 people just to do the Illinois returns because the software that we use doesn't handle it very well. So that's pretty much manual that we have to do all of that manually on the Illinois website. So yes, it's a pain in the neck, but I still say that we need to do that, or you need to do that, because Illinois is very aggressive in auditing people, and they will come back after that. So it may cost you a lot of money. And the fix, like I said, is fairly easy, and it could be retroactive. So that's why I say comply. When you're doing tax planning, it's always better to do what a state wants you to do. If you get audited and you haven't been doing what the state wants you to do, at that point, you throw everything you can against the wall. But unless you want to spend a lot of time in court, it's always easier to do what the state wants you to do, because it costs money to go to court, and it takes time, and penalty and interest could stack up, and you may not win. So when we're doing tax planning, always, if the state could take a position that's opposite of yours, we always want to take the most conservative position and collect the tax versus saying, well, the state's wrong, so I'll deal with this when and if the state ever contacts me. So that's some information about Illinois. Um, there are 9 states that do not have local rates. So earlier it said the majority of states don't have local rates. There are just 9 states that I know of that do not have local rates. The average local rate is about 1.5%. However, very misleading. Some states' local rates may be as high as 9.75. Alabama, Colorado, Louisiana have some of the higher local rates with averages of 5.22, 4.82, and 5.07 respectively. Now, Colorado, um, their state rate is sometimes less than half of the total rate. So the if you're getting the local rates wrong, these can start adding up very quickly. Local taxes can include county, city, district, other special taxes. They're generally shown as a single rate, even though there may be multiple jurisdictions included in that local rate. The local rate is added to the state rate and it's shown as a single rate. And that's what, an auditor is going to be looking at when they go out there. All right, as we mentioned, 13,000 different taxing jurisdictions out there. They don't all set their own rules like home rule states, but they often set their own rates. If you have a lot of transactions, this is something that can be quite confusing. And this is one of the areas I sort of have a love-hate relationship with software companies. If you ever listened to me before, you probably have picked up on that. This is one area that I think that the software companies do very, very well. And if you're doing a lot of transactions, you really have to have automation out there. This is not something that can be done manually. There are rate tables out there. A lot of people have legacy systems that can't connect to the different software companies that provide rates, or it's too expensive for them to do. So there are rate tables that you can sometimes use. Rate tables are generally based upon zip code. And in a lot of local jurisdictions, that's not really good enough, um, because you could have 4 or 5 zip codes in one county, and have multiple rates there. So there are some inaccuracies when trying to use rates based upon just a zip code rather than a geocode, which is what most of the software companies use nowadays. All right, so we've talked about origin versus destination a little bit earlier. Most states have moved to destination sourcing to determine local sourcing. Some states still use origin-based sourcing on intrastate sales to determine the local rates. Some states use a modified origin. Modified origin often has different rules for different scenarios. So let's look at Illinois and Texas. All right. And uh, so Illinois, we basically talked about. So this is just going over what I've mentioned earlier. The company has a physical presence from which deliveries are made in the state. The seller needs to sign up for the retailer's occupation tax, that's their sales tax, and collect based on the ship from location. That's an origin-based selling. Scenario 2, the company is a remote seller, ships into the state. Seller needs to sign up for the retailer's occupation tax and collect based on destination. It's almost 4,000 jurisdictions. It's currently facing a challenge. And then scenario 3, company has a physical nexus in Illinois, like a salesperson traveling into the state or an independent contractor traveling into the state, but they have no inventory there. You should register for the retailer's use tax and not collect any local taxes. So We advise some of our clients, especially when they're doing their own sales tax returns and don't want to take all of this extra time to source the 4,000 different jurisdictions, send a create some sort of physical nexus, send a salesperson, send an independent contractor to the state a couple of times a year, and you don't have to worry about this. So if you are a true remote seller, I would follow the rules as the way they have it now, but it's real easy to change the rules for yourself. All you have to do is create some type of physical nexus. So have a salesperson travel into the state 2 or 3 times a year. A lot of times that's going to be a lot cheaper than having to comply with, figuring out 4,000 the rates in almost 4,000 jurisdictions. And then when you're filing, that's when the big problem comes in because each sale has to be sourced, when you're filling out the returns to that jurisdiction. All right, so Texas local tax sourcing on interstate sales, that never crosses the a state line. Texas generally looks to the location where the order was first accepted for in-person sales. For orders not placed in person, the sale is sourced to the location from which the order will ship. If the order is not shipping from Texas, it goes back to where the order was accepted. If the order was received outside of Texas, destination shipping is used, and that would be where it's being shipped to. Now, this is important because sometimes, someone will take an order at a warehouse. Well, that's not a place of business for Texas. Texas says the orders have to be accepted at a place of business. And a place of business is defined as some place where I think it's four or more orders a year are actually accepted. So if the warehouse is not where the orders are being accepted generally, then it would not be the warehouse whose jurisdiction you use. And in Texas, the state rate is 6.25%. Local rates range from 0 to 2%. And there is a state cap of 8.25% in Texas. The average rate in Texas, this changes. Last time I looked, it was 8.17% when you add in the local rates. But all of the big locations, like your Dallas, your Fort Worth, all of the big cities out there are generally going to be at 8.25%. All right, so how to figure out the rate? You can call the state. You can check the state website. If you're doing hundreds of or thousands of transactions a day, not very likely, but we have some clients who have, maybe one sale a week or sometimes one sale a month. They're huge, 3, 4, $5 million sales, or maybe they have 2 or 3 a month. Well, that's a viable alternative. If you have a low frequency of orders, then you can call the state or check the state website. There are free rate lookups out there where you can type in an address and it will tell you the rate for that. The state websites often have these free rate lookups, and some of the bigger software companies have them. A complaint that I hear is that sometimes they don't keep these as updated as they do for their paid for services. You can use a rate table. As we mentioned earlier, sometimes that's the only solution that you can utilize because you don't have the ability to automate. There are limitations in rate tables. Number one, they're not cheap. They should be, but people want you to use their automation, so they've all raised the prices on the rate tables. And the rate tables are going to be zip code based, where the automation nowadays with most companies is going to be geocode based. And automation, this is an area where I believe if you're doing a lot of transactions, you got to get with one of the software companies out there. Now, a lot of people always look for the cheapest solution. And I have found that cheap is the enemy of good, especially if you're asking these software companies to also figure out the taxability for you. Not only to provide a rate, but to tell you if this is taxable or not in that state and what state's rate to charge. Not all software companies are created equal. And if something is a lot cheaper than all of the other software companies out there, there's usually a reason for that. Now, if you're a very small seller, you have small problems. So any limitations of the software companies are going to be limited. But if you are a large seller, you don't want to be utilizing one of these cheaper solutions because your problems could be huge. I mean, I have a real issue with some of the larger companies like an Avalara, but when it comes to rates, I think that unfortunately, it's you'd be darned if you do and darned if you don't. So I do recommend them a Vertex over an Avalara, Ceratax over both Avalara and Vertex. Ceratax is a newer company out there. They've got all of the latest technology and very, very good company. And they don't offer services. They concentrate on what's important, which is the software. A lot of these other software companies spend more money on marketing than they do on upgrading their software. So, but I think that, despite all my misgivings about software companies, this is something that if you're doing a lot of transactions, you've got to automate. And at this point, I'd like to open it up to questions. Do we have any questions out there? All right, I don't see any that have come through the Q&A button. If you have a question, as I'm wrapping up here, go ahead and get it submitted. I'm sorry if this has not been the smoothest of webinars out there. We've had a number of technical issues. As I said, Ellie's up in the mountains of Colorado, and she usually does all the behind the scenes work here. And I've got some internet issues myself today. So despite that, we hope that you have learned something. And we hope to see you at our future webinars. We have a whole series out there. And if you have any questions that come up after we close out today's webinar, you can send them to contact@sales tax and more, and we'll see if we can go ahead and get those questions answered for you. Sometimes a consultation may be the way to go. Sometimes a question is too involved for a simple email answer. But we will get back to you one way or the other. We've got someone thanking us. I thought it was a question coming in, but thank you for the thank you. And at this point, it doesn't look like we have any other questions coming in. So I wish you all a great day. And we'll get back to you with the poll questions. There were 3 of them. I don't have access to it right now. So we'll follow up with that. But thank you, everyone, for joining us today. I hope you have a great day and look forward to the weekend. Bye-bye, everyone.